This is Robert Kraft, and I'm your host on the Planet MicroCap Podcast. And with me today is someone who I've followed for a very long time. It seems like look, don't base it on what you see, in appearance right now. But, I think we both have been in the game now for a few years. But my guest today is Dave Waters. He is the founder of Alluvial Capital and also the author of OTC Adventures.com. Dave, welcome to the Planet MicroCap Podcast. Thank you for, it's great to finally have you on here.
Yeah, thanks a lot. Super excited about it.
Hell yeah. No, I'm just stoked that you had the time to join us today. So, for those who may not have read OTC Adventures or now know about Alluvial Capital, let's actually, even before that, I just want to know, like, what got you interested in the wide world of investing? Let's start there.
Yeah, that's a good question. I mean, it really goes back a long way for me, probably, 20 years. I'm 34. I'm still fairly new in this business, but I remember being a young teenager. It was actually around the time of the internet bubble when I started looking at the newspaper and thinking, what is this Dow Jones? What is this S&P 500? And all I knew was this thing seems to get more and more valuable every day. And it just so happened that at the same time, my dad's company that he worked for his whole life did an IPO, UPS. And they went up like 35% on day one. And of course, he was thrilled and changed his life. And I thought, well, this is pretty amazing. Like, people can invest. I come from a pretty rural, pretty blue collar community and didn't really know anyone who had a stock portfolio or anything other than maybe a pension. But the idea that you could take money you had and buy stuff and just wait around and it would become a lot more valuable really, really quickly, that was really attractive. And then, of course, as we all know, things went sour pretty fast. And it turns out there's a lot more to it than just buying whatever, and it doubles or triples in a couple of weeks. But I kind of had the bug, even at a young age. And I started started just watching stuff in the newspaper and going to like NASDAQ.com every day with my dial-up internet connection. And it was just really, really interesting. So, I had the bug pretty early on.
Nice. What were you looking at early on? Were you doing like the fantasy stock portfolios that, I used to do some of those back in the day, I remember. But were you actually going in and putting, hard-earned dollars into the market to learn, or were you still kind of like, I want to learn more about the game and then I'll start investing once I feel like I'm more comfortable?
Yeah, well, I didn't really have any hard-earned dollars when I was a teenager. And so I was just sort of waiting and watching. And at first, I was literally just looking at a chart and thinking, oh, it's going up and to the right. This must be good stock. And if I had money, I would put it there. It wasn't until I was about halfway through college, had a little bit of money from a summer job, that I actually got a brokerage account at Scott Trade, I think, and started buying stuff and promptly lost all my money because I had not a clue what I was doing. But I was learning little by little, and I studied finance. And my first job was in a wealth management division of a bank, and learned more and more. Did the CFA, and it started becoming a bit wiser and getting some experience under my belt. But like most people, I still was just kind of stumbling in the dark until I actually started to read serious materials about investing, and particularly value investing. And that's when I started to apply myself more seriously and thought, you know what, this is the career for me. I want this to be what I do. And not just because it's fun or it's lucrative, or it can be. Really, it became sort of an obsession. I don't know too many people in this industry who really, really build something and succeed without devoting themselves almost entirely to it. And I started doing that in my early 20s.
So what was that reading material that just turned you? You said you were investing and you lost all your money because you didn't know what you were doing. So what was that one book or paper, who knows, Warren Buffett, investor letter, what was that one thing that turned it for you?
Yeah, I guess it was a little book I picked up, I think at a thrift store or something when I was in college. It's called What Works on Wall Street by James O'Shaughnessy.
Yep.
And those guys are pretty active in the game still. And I started, it was kind of a revelation to me, like, wait a minute, you can not only just invest and make money, but if you focus your efforts on a particular part of the stock market, you kind of turn the odds in your favor a little bit. And that just happens to be, historically anyway, the small companies, the less liquid companies, and the value companies. There's a number of ways to measure that. But I thought, okay, this kind of makes sense. Here I am sitting here. I was maybe 25, 26. I have a 30, 40, 50-year time horizon if I'm lucky. I can handle the volatility. I think I will tilt my portfolio in this direction and start doing my own research, and hopefully it'll work out well for me. And turns out that just jived really, really well with my own personal interest. I've always been the kind of guy who enjoys a treasure hunt. And so, I mean, I spent a lot of time in my hipster years digging around for vinyl and stuff like that in thrift stores. And so just the idea that I could spend time looking in the sort of the obscure discount bin of the market for gems really appealed to me. And so I started doing that.
Look, man, once a hipster, always a hipster, okay? I'm sure you're still going to and getting that vinyl.
Yeah, that's true.
So then I got to ask, what then inspired, because we're going to get to your investing strategy soon,
Sure.
because I mean, it's very, very interesting. I've had a few people on here that have a similar style, and I'm curious to how you attack it. But, I really also want to know is, what inspired you to then start OTC Adventures and then eventually Alluvial Capital?
Yeah, for sure. So like I mentioned, I was working in the wealth management division of a bank. At that point, it was Bank New York Mellon back at Pittsburgh, which is the area I'm from, and it was okay. I mean, they were and still are like a really, really sleepy trust bank. I mean, it's the kind of place you go if you're worth several $1 million and you don't really care how much you grow your wealth, but you don't want to lose money. And they were good at that, but it certainly wasn't a place for anyone with a lot of ambition or any kind of entrepreneurial bent. And so I started looking for my way out. I saw what my career would be if I stayed there, which is just entertaining clients 4 or 5 nights a week and hugging the benchmark. And not for me. I could easily find myself 20 years down the road and frustrated and no thanks. And at the same time, I said to myself, okay, look, here you are in Pittsburgh, cool city, but not exactly the financial capital of the world. No real, went to an obscure little college, was not an academic standout in any way, no amazing banking internships under my belt. If I were to get hired at a hedge fund or anything like that, my only hope is to create my own research and publish it. And if it's decent, somebody will like it and they'll give me a shot. Lucky me, at the time, the internet, the world of seeking alpha was pretty brand new, and there were all these investing blogs that were brand new. There just wasn't a lot of good quality commentary on stocks, and so there was a market for that. And I told myself, if I start a blog, even if nobody reads it at first, if I publish good stuff and my ideas are unique and ultimately they, on average, work, I'll get attention. And that's exactly what happened. I started writing in 2012, and I think I was just super excited when I had like 50 subscribed readers after 6 months. And now I have a few thousand, and I don't even write as much as I used to. I'm just busier these days. But it was really, really thrilling to see people actually enjoy what I was writing. And almost without fail, after I profiled a company, I would get an email from someone saying, I'm the second or third largest shareholder in this company. I love it. How on earth did you find it? And we'd get into a good conversation, and they'd often become mentors or connect me to other people they thought I should know. And it was a really amazing way to network. And so I kept on doing that in my nights and weekends, and probably on a slow afternoon at work now and then, writing these blog posts. And it got attention, and it was a great way to get launched.
Mm-hmm. No, I love that approach. I mean, my friend Brandon Mackey started a very similar way. I know Nate Tobik started a very similar way.
Sure. It's a good friend of mine.
Yeah. Like these, I mean, you guys are all such good writers and put out, it's not just even really the quality of ideas. It's the way in which you go about expressing your ideas, which was revolutionary at the time, I think.
I think so. It was just so accessible compared to these sell-side Wall Street reports, which were really, really hard to access if you were just a regular retail investor. And Nate's blog was a big inspiration for me. It was funny. I remember reading Oddball Stocks, still do. And I sent Nate an email. I was like, I love your stuff. If you're ever in Pittsburgh, I'd love to buy you a beer or a coffee, whatever. And turned out he lived like 3 miles from me. So
he's a head guy too. That's too funny. So then from, I mean, I'm just assuming, you did pretty well to get to the point where you then felt confidence to start Alluvial Capital. Am I on the right track there?
Exactly. What happened was I'd get emails from people saying, I like your ideas. No one else there is doing exactly this. Do you manage any capital yourself? And I'd have to say, I don't. I work for a large bank. I can't compete against my employer. And the CFA Institute would not like that. And if they'd say, if you ever go off on your own, let me know. I'll sign up. And so there I was 29, I guess, and didn't really have a lot of day-to-day responsibilities. I'm single, living in a small apartment, no kids. Had some savings, and I thought, well, this is the time to go for it. I'll start up an RIA. If it gets traction and it grows, that's fantastic. If not, well, at least I tried, and I won't regret not. And I'll just go back to work somewhere else. But thankfully, I started in, I guess, February of 2014 with about 6 clients and less than 2 million under management. And thankfully the returns were good from the get-go, and I got a lot of good referrals, and here we are. Hard to believe it's 6 years later, but we've grown and done well, and it's still as much fun as it was from the beginning.
Very cool. So now to dig into the strategy itself that got you to where you are today, so I had to go back to where it started, to your very first blog post where you said that your task, and I quote, your task on OTC Adventures is to find and profile the most intriguing investment opportunities I can find among the ranks of the market's most neglected and suspected companies, OTC BB and pink sheets stocks. So,
Yeah.
we kind of already went through what really drew you here. So what was your approach, or what is your approach then to finding the quality ideas in this realm?
Sure. It's evolved a little bit over time, but I think the bedrock has always just been the old brute force, start with the A's approach. I don't know a better way to find value sometimes, because oftentimes the stuff we find that we like, it doesn't screen well, or sometimes the financials aren't even available on the SEC or what have you. And so there's really no shortcut other than going one by one through a list of stocks and checking out the financials and drawing conclusions about the company. And that was our goal from the very beginning. And I have to say that back in 2012, the OTC markets were just unbelievably, it was a target-rich atmosphere. I couldn't go through a list of 100 stocks without finding 4 or 5 that were just screamingly cheap. I mean, stuff that was trading at 50% of book value and 5 times earnings with net cash on the balance sheet. And what had happened was investors were just so scarred and stunned by the financial crisis and the market crash. There was just very little liquidity, and nobody was interested in putting their neck out on any of these investments. And so they were just sitting there and incredibly cheap. And over the next couple of years, they were bid up, and a lot of them were taken out, unfortunately, too early for many of them. But it was just really, really easy. And it's gotten tougher. I mean, with the markets on this incredible run, today. Yeah. It's you have to look a little bit harder than you used to, but I still think for the truly committed investor who wants to find ideas that are just out of consensus and before the market finds them, you just have to go company by company. It's not always fun. It can get a little boring, but you'll find gold if you just keep going.
I was going to say, you said it's just sheer brute force of will to really find some of these names. Yeah. I mean, so what exactly was that brute force of will that you would do? I mean, would you literally just A to Z here? Because as you said, screening for some of these names, they won't even show up because you're looking at financials. Maybe the last one that was publicly available is
right.
Just if it were today, like back in 2017.
Mm-hmm.
So I mean, what was your process? Literally A to Z going through each one?
Well, what I started with doing is I created my own sort of proprietary database where I did like some people do, where I literally downloaded the entire symbol file from otcmarkets.com, and there's something like 9,000 securities on there. And some of them, though, you can get rid of pretty immediately. The share price is 0.00001
right.
cent, and there's no revenue, or there's a lot of garbage that you can discard pretty quickly. But after going through that, I was left with about 1,000 or 2,000, somewhere in there, names that were actually real businesses. Not saying they were attractive investments, but they had a legitimate operation. And from there, it was just a matter of going through the financial statements and thinking, okay, here's a company with real revenue and actual profits, and they have cash flow and assets, and this is they have a product or a service that's valuable and will likely remain valuable, and you can just. And so what I managed to do was whittle my initial list from several thousand down to 400 or 500 names that I would just keep tabs on. I try to revisit each symbol at least once a month, update the valuation if they had a new quarterly come out or some kind of press release that was material for them. Also, I made another list of about 600 community banks, which was another. So, and this was rather time consuming. I mean, keeping tabs on 1,000 stocks is pretty ambitious. But I pretty quickly realized as you do this, you get faster and faster, and you become faster and quicker at pointing out or recognizing what's bogus and what's actually legit. And so you end up concentrating on the stocks that are actually valuable. And that's where a lot of my best ideas came from early on. It's just whittling down the list to what was the most legit, and at that time, what was the cheapest.
Got it. So then what was your criteria? I'm going to ask you later, how it's changed, but maybe at that time, what was your criteria then for a potential new investment? And then let's get into it. How has that changed over the years?
Sure. I'd say that at the very beginning, my approach was pretty heavily quantitative. At the time, I was looking for, mid-single digit normalized earnings price ratios, just normalizing for one-time items. If I could buy something, a legitimate operation at 5 or 6 times normalized earnings, I had a pretty good odds of succeeding with that investment. I mean, I also wanted a good balance sheet. I wanted repeatable free cash flow. I wanted growth. Growth, of course, is a good thing, but I wanted profitable growth, not just revenue for the sake of revenue. And so I wanted to see a trend of increasing margins and just a little bit beyond that. I just wanted to see a business where it seemed like the management was well incentivized. They were big owners of the stock themselves. They paid themselves reasonably, and they did smart things. I think if you can just avoid management that does stupid things, you will rule out a lot of errors and save yourself a lot of heartache and headache. So that was my approach at the beginning. And frankly, like I said, it worked really well because the markets were just so cheap back then. My process has evolved over time to be much more heavily qualitative. And a lot of that is because the simple, very obvious statistical value has sort of evaporated from the markets. Even the markets I look at, which don't get a lot of the ETF and mutual fund flows, they've still been bid up quite a bit. Mm-hmm. And so these days, I spend much more time assessing business models, evaluating competitive position, really sort of digging into the qualification and motivation and of the management team, because frankly, I just lost too much money investing in companies where they looked fantastic, but all the value was ending up in management's pocket or was just being obliterated in one terrible decision they made. And so these days, I spend a lot more time filtering, I guess, for quality. That's not to say I only invest in the so-called compounders. There are very, very cheap stocks out there where the business isn't the most wonderful thing in the world, but nonetheless, they make money and they reinvest successfully, and it's a legitimate operation. But these days, I spend a lot more time thinking about businesses and less time focusing on the numbers on the financial statements and the ratios.
That was going to be my follow-up question, because as you said, especially in the arena that you look in some of these dark, illiquid stocks, I mean, they've just been bid up or just straight up taken out over the last couple of years, with just the valuations kind of going nuts. Not maybe not. It's February 24th, so maybe not today. But but you, as you said, valuations are just going up and up. So how then did you develop that skill to evaluate management better? Because it sounds like really you were very focused on the quantitative side. What did you do to help yourself get there where you felt more comfortable evaluating, all right, this is good management, they're good capital allocators, running the business well? Talk a little about that.
Sure. I'd say I learned most of it the hard way. I don't know, some lessons you just have to learn by straight up losing money or investing in something that you thought was X and it turns out it's Y, and Y is really, really bad and not what you wanted to invest in. I'd say that it's just battle scars. I mean, I had several investments where management turned out to be dishonest or conflicted or just unfocused. And so honestly, I spend more time talking to management than I used to. Now, I'm still not at the school that says, you have to sit down with management and you have to find out, what their birthday is and their favorite color and memorize their anniversary and how many kids they have. That's honestly, I think you can get a little bit too emotionally involved that way, and it's hard to change your mind if you need to. But it does matter who's running your company, especially at the small end of the market capitalization scale. A lot of the times these people in charge are maybe not as professional and as professionalized as they would be for the S&P 500. Doesn't mean they're stupid or incompetent at all. But I find that the culture coming from the top has a much larger effect on these small companies that have maybe as few as 5 or 10 employees up to a couple hundred, compared to a company that has several thousand. They have more of an institutional culture. But I find that just the change in the CEO very much drives the company culture in a small operation. And so it depends a lot who that CEO is and how much you can trust that person. And so I had to learn a lot of hard lessons. I had to lose money. I had to see my investment not work out. And I had to get more confident in talking to these companies. I think my background personally, coming from, like I said, a blue collar background and feeling like, who am I to approach these mighty CEOs and companies? That's not true at all. If you're a shareholder, you're an investor, and you have every right to approach that company and talk to them. And if they won't, well, that says more about them than it does about you, and you may want to focus your investments elsewhere. And so just learning to realize that, hey, I'm an investor, I have rights, you need to answer my questions because you work for me, is an important part of the process. And of course, be nice, be respectful, be a good guy about it, but don't be afraid to approach the company and ask the questions that you want them to answer.
But let me ask you this. I mean, because, again, we're dealing in some of these companies with darker liquid stocks. Some of them, most of the time, probably just don't even want to be public to begin with. So what if it's a company that you're like, oh man, this checks all my boxes. I want to talk to management, but management's just literally like, I don't care to talk to you. I'm just running my business. Leave me alone. Have you come across a few of those situations?
I have. Maybe for me years ago, it was, well, okay, I'm just a little investor. They don't want to talk to me. Fine, they're running the business, and okay, I'll buy some shares anyway. These days, that doesn't work for me anymore. I think if you are a public company, whether you want to be or not, you have an obligation to talk to investors who approach you. If you don't want to be public, great, buy out your shares, go private. But don't act like you're a private company if you have shares that are publicly traded, even if you're not an SEC reporter. And so these days, if I approach a company and I get radio silence, or I get, here, sign this NDA, or just any kind of hostility or secrecy or paranoia from management, I do get that. That's almost always a pass. Maybe the very limited exception is that I look at the history of the company and they really do have an excellent history of running the business well and treating shareholders fairly. I might just conclude, okay, they're just publicity shy, or they just really are that busy making deals and running the business, and maybe I can overlook it. But they truly have to have an exceptional track record and a history of treating their shareholders, treating them well and not self-dealing. But those companies are really rare.
Gotcha. So, I really also wanted to, I asked, how your strategy has changed over the years. And one of my main questions really was because, you went from being your own individual investor to now, running a fund at Alluvial Capital. And I've interviewed a couple individual investors that play in the same arena as you, from Dan Shum, from No Name Stocks, Doug Moen, from No Called Strikes, and many others, I'm sure. And so, for you, what would you say is the biggest difference going from an individual investor to now running a fund, now focused in this? I mean, I'm assuming off the bat, getting a lot more calls back.
Yeah, that does help. A little bit of clout. It does give you, for better or for worse. That's true. I would say that, honestly, managing other people's money is very, very, very different than managing just your own personal capital. You feel the pressure. I mean, I take it very seriously. I know that the investors who invested with Alluvial, this is people's hard-earned money that they sometimes, as the result of years of careful saving and investing and living below their means, and so it's a sacred trust, really, to take care of that. And so I take it very, very seriously. And honestly, I really, really feel it if I end up making an investment that think actually was not the greatest choice, or I made a mistake, which is why you try to make fewer and fewer of those every day. But it's tough sometimes if you did all your homework on an investment and you're really, really confident in it and you buy it and the first thing it does is drop 25% or 30%. That's really tough. That can seriously rock your confidence. And so I think it's taken me years to build up my skills and sort of coping with the emotionality that can occur in investing. I mean, you invest your own money and you lose it temporarily, you hope. You feel bad, you feel dumb, but in the end, it was your decision, it was your money, you're the only one who's affected by that. That's not the case when you transition to managing other people's money as well. And so I've had to develop, you really have to do your homework. I've had to develop more confidence, my skills. I've had to develop the ability to roll with the punches. If the market's just beating me up like it does now and then for everyone, but that's the biggest thing about it. And I answer to higher authorities, which are our clients and limited partners these days, and you can never forget that. But it's been wonderful, but it's hard.
I was going to say, I mean, it must also be harder in terms of position sizing too. You're looking at some of these dark liquid stocks. You're like, okay, this thing basically is trading by appointment at this point. And, I have a big block of shares that I'm looking to get into. And even if it's just a regular OTC company that even might be fully reporting, that's still very difficult to then size into. So can you talk about your strategy there a little bit?
Oh, totally. Yeah, that's another thing I was about to say is I actually think, and Alluvial has about 40 million under management right now, which still makes us a very small firm in the scheme of things, but is certainly quite a lot more than we were managing just a few years ago, and certainly far magnitude larger than my personal portfolio was when I was just running that. And these days, honestly, there are some stocks that Alluvial cannot invest in because they're just too small. I actually think that's a pretty large advantage. If you're someone who for in the context of their portfolio, where $5,000 or $10,000 is a major part of the portfolio, that's an advantage because you can truly buy the smallest, cheapest, most illiquid stuff, and you can do very well. Where for even a small fund like Alluvial, that's no longer a possibility, really. And so I hope people take full advantage of that. But at the same time, yes, as we've gotten larger, we've had to think much more about the sort of stocks that we want to purchase. And the biggest thing has to be, I have to know before we buy a stock, is this something I'm going to be okay with holding if it takes several years for my thesis to play out? And I have to be okay with that. If I buy it and 6 months later I change my mind, well, it can be hard to get out, even because we might end up owning 2, 3, 4% of the company, and that might be 15% of the free float if the company is controlled by its insiders or family. And so we spend a lot more time thinking about what do we do if things don't go how we want before we ever get into a stock. It wasn't a big deal when I was an individual investor. It's like, okay, I'll buy $5,000 of that. If I just decided I wanted to sell it, okay, boom, it's done. It took one day. No longer. It could take months to fully sell out of something we no longer want to hold now. And so that's, even at a small firm like ours, the ships on the ocean metaphor is overdone, but we're no longer a canoe. We're more like a yacht, and we're still not the battleship or the super carrier that Vanguard is, but it's harder to turn around than it used to be. And so we have to spend more time thinking about position sizing and what do we want to get into versus not even try because it might be too small.
Mm-hmm. So then I have to ask you this question too. I asked this to Dan because I'm just very interested. When you're looking at some of these companies that are in your wheelhouse, I mean, what's some of the hair that you are comfortable with on these companies?
Yeah, that's a good question because as you well know, and as Dan well knows, there are a lot of them that have some hair, especially this level.
I'd say most of them.
They don't get the same kind of scrutiny from institutional investors or really anyone as some of the larger companies do. And I think sometimes you'll see related party transactions at a lot of these companies where the company is in some way contracting with management or their shareholders for certain services. And some of those are okay with me and some of them are not. I mean, sometimes you'll see, okay, the company is paying a law firm to do its just to handle its legal businesses, and it turns out the controlling shareholder is a partner in that law firm or something. That's not really a big deal to me. And in fact, they might even end up saving money that way, but it still has to be disclosed because it's a related party transaction. A lot of manufacturing or distribution firms, you see that they're actually leasing a warehouse or something from the shareholder or management, and that's generally okay with me too. As long as they're paying a reasonable rate, and you can sort of check that by checking the local comparables in the commercial market for there, and that doesn't bother me too much. On the other hand, I don't like seeing the company pay for the management's country club membership, or it's egregious how many small companies are chartering planes and jets for their management as well, which is just absolutely ridiculous. I don't like to see them paying for perks. You'll see a lot of microcap and liquid management that's actually getting paid better than their large cap counterparts, and that really rubs me the wrong way. I mean, if you want to treat yourself like a family business, you should be a family business and not have outside shareholders because you're not upholding your fiduciary duty that way. But yeah, I mean, each case is different, and every investor is going to have to figure out what they're okay with and what they're not. But I don't like anything that suggests the shareholders or management is using the company as a personal wealth transfer device or piggy bank is sort of a red line for me. I don't like that at all.
My next follow-up question then to you, and this is kind of projecting a little bit. So, I guess there's no wrong answer here, but it sounds like you really got your start during this crazy bull market from that 2012 time, and today's obviously not their best day, but it's still a rocketing bull market now. I mean, have you given thought to how your strategy will work? And, these are all cyclical. We all know that eventually there's going to be a downturn in the market. Have you thought about how your investing approach will shift or how you might go about, looking at potential new ideas once that down market does come?
Absolutely. I think you're right. It was a lot of investors have been investing with the wind at their back for most of the last decade, and feels great. I mean, everyone enjoys it when it's a fairly smooth ride, but we know that doesn't last forever. And so I do think about that in terms of portfolio construction. What should we be doing now in the good times to prepare for the inevitable rocky times whenever those do arrive? Maybe it's now, maybe it's 6 months, maybe it's 3 years or 5. Who knows? Anything could happen, but I think our greater focus on quality will serve us well. Like I said, we also put a lot more emphasis on balance sheet strength than we were just a couple of years ago. Frankly, got burned a little bit on a couple of companies that had more debt than they should have, and took it on the chin when their individual industries ran into some issues. And so I think today, though, our portfolios are probably 2/3 companies that have net cash on the balance sheet, and I think that'll serve us well for whenever a downturn arrives. Because there's optionality in that. I mean, companies can always buy back cheap stock or go out and purchase a competitor opportunistically, and they don't have to worry about refinancing. I think that if you have a company that can fund itself internally and chooses to, it's not a bad time for them to do that. I'm a little wary of companies, with exceptions, but if a company is going out and making massive capital outlays now, my first question is, well, why didn't you do this a few years ago so you could have set yourself up well today? But is this really the best time to get a little bit out over your skis in terms of your balance sheet? And I mean, who knows? But I prefer companies that take the longer term view and have a balance sheet that can last them through whatever happens next. I'm spending more time than I used to thinking about, okay, how am I positioning myself in the next downturn? And sometimes that can be a bit frustrating if you're investing in defensive companies or companies that have a solid balance sheet and they're just kind of hanging out there, or maybe going up just a little bit when the market flies, and you see all these fast gunning, aggressive companies going up 20-30%, and it can be a little frustrating to see your stuff just sit there. But I think you have to stick to your process and insist on quality, and you'll make it through.
Mm-hmm. So I have to ask, and as I told you before we press play, I'm not going to ask about individual stocks, but what sectors have been interesting for you that really have been fitting your thesis recently?
Yeah, well, I'm pretty lonely in this, but we've been big investors in rural telecom, actually. When I think you pitch any stock in the rural telecom segment to any kind of investor, and their first question is going to be, why would you do that? There's no growth there. These companies are dinosaurs. I mean, who has a landline anymore? And I would say, yes, that's absolutely true. People are ditching their landlines. But what I think a lot of people don't realize is that these rural broadband, I tell myself they're really not rural telecoms anymore. These are rural broadband providers. The FCC has changed how it subsidizes these companies, and rather than essentially paying them to provide landlines to rural areas and mountaintops and valleys in Minnesota and West Virginia and everywhere else, the FCC is now very generously subsidizing these companies to build fiber optic networks. And those fiber optic networks are what will enable these companies to sign up new customers and give them broadband access, most of them for the first time ever, and really ensure that these companies are still viable 30, 40 years from now when no one has a landline, but everyone still needs more and better broadband service than ever. And so we've done very, very well in that area by seeing the market slowly wake up to the fact that these really aren't melting ice cubes. These are businesses in transition. A lot of them have strong balance sheets, and that's another thing. The major large cap rural telcos like Frontier and CenturyLink and Windstream have all just been obliterated. And the reasons are they have way too much debt. And they're operating in areas where they're competing against Charter Communications and Verizon and Comcast, and that's a very difficult battle to win. However, if you invest in some of these rural telcos, they're the only game in town. There's no one else in their market rolling out fiber. Those customers can have internet from them or no internet. And that's an easy choice for most customers to make. And so they've done very, very well. And I think this is the kind of business that's pretty resistant to a recession as well, because you can stop going out to eat at a restaurant, you can stop doing whatever, but you still need that internet connection to entertain yourself, or it's cheap entertainment, or geez, to apply for jobs these days. I mean, good luck getting a job without an email address and probably an online application. So I like those a lot.
No, so true. I mean, you also hear literally every candidate for president talking about how they want to bring internet to, all these different rural communities that still don't have it. So, I mean, it sounds like there's an opportunity there.
It's been a good market for us, and I think there's more upside there. I guess, honestly, more so than industries, we've been finding just market niches that have gone unexplored. Mm-hmm. We do a lot of international. I think that's a differentiator for Alluvial as well. We don't confine ourselves to the U.S. and Canada. I think if you're willing to look at Europe and Asia and places like that, you have to be even more careful. You have to insist on that margin of safety and really do your due diligence. But those markets have just, as inefficient as U.S. micro and illiquid markets can be, it's so much worse overseas. You find companies that are just totally neglected and no one knows about them. And we've done well investing. I think one of our recent areas where we found a lot of promise was something we did not expect at all, is the IPO market in Italy for small companies. It's really, really intriguing. So the Italian government a couple years ago changed some laws that made it very attractive all of a sudden for small and medium-sized businesses to do an IPO. They did a major tax credit for IPO expenses, and because the Italian stock market is kind of undeveloped. There's a lot of very large firms. Yeah, but for whatever reason, most of the small companies in Italy are still family owned, and the government wants them to list, which makes sense. And so compared to like the US IPO market, it's nearly always, loss-making firms or firms that already have several hundred million in revenue, because before that they're owned by private equity or venture capital. Then finally they list once their hypergrowth slows down. Not the case in Italy. There's not a lot of private equity, not a lot of venture capital. There's some. But these companies IPO, and sometimes they sell as little as 5 million worth of stock, which is just insane. And so these IPOs are not being bought up by big banks. I mean, what big bank wants to put in for €500,000 of some little family-owned company? But we've done really, really well. One of our best successes so far, and it is a company we own called Intred, is a fiber optic network operator in northern Italy, and it went public at like 3.5 to 4 times EBITDA, which is just absolutely wild for a good company with lots of growth potential and a good balance sheet. And there's others too, but that's one that's been a lot of fun for us. And who knew? If you told me a year ago that, hey, you should really check out the Italian IPO market, I'd be like, are you serious? But it turned out to be a fruitful area for us. And so we're always looking for what is that next market niche that no one's really looking at, and there's a lot of potential.
I was going to say, how'd you find it?
We're always looking for new markets. We're always checking out the various level or the various categories because of every market. Because a lot of markets, just like the U.S., there's the listed companies, the NYSE and Nasdaq, and below that there's OTC stuff. It's the same way in Europe. They have their premier list, and below that is the alternative access market. And sometimes the lower tiers don't get a lot of attention. And so that's where we've been having fun.
I should introduce you to one of the guests I've had on here, Thomas Backrack from PFH. He's got stories for days when it comes to investing in international microcaps.
So love to talk to him.
It's too good. So very recently, actually, Ian put out a tweet when he was talking about the focus on niche markets. That's where really your wealth develops, more or less. Yeah. When you can find companies that are really building out their, maybe they have their I think he was talking about how, finding companies in those niche markets that are making 5 million in revenues. You want to find those that can grow that to 50 million. And that's really your market opportunity. Is that where I'm sure you would agree with those sentiments.
Oh, for sure. I do think investors should be a little bit suspicious of their own ability to project that kind of revenue growth. Because a business going 10x in revenue, that's a big deal. And it's awesome if you can find a business like that. But I don't think anyone should ignore businesses that won't do 10x, but can grow their revenue by 50% in 3 years. Those businesses can do exceptionally well for you as well. So I do think there are some microcap investors who are really only interested in the kind of business that can be 10 or 20 or 100 times larger a decade from now. That's awesome. We do a little bit of that, but I think there's also plenty of potential businesses that are just going to have a moderate growth rate, but do smart things with their cash and just operate their business well, and are just good operators. I think you can make money on those too. It doesn't have to be, well, you're going to lose everything or you're going to make 100 times your money. I think there's a lot of space in between for a company that can make you 15 to 20% a year for a decade. You'll make a lot of money that way.
Gotcha. All right. So I wanted to move on to a topic that I talked with Dan about, as well as with Cromwell Coulson from OTC Markets. And this has to do with back in, I think it was August or September, maybe in October. It was late last year, where SEC put out their proposal about halting trading in dark stocks. So I really wanted to get your opinion on the matter.
Well, I think it's a terrible idea. I'm sure that's not a surprise.
Not a surprise.
I do understand I know what they're going for. And I do think the goal of protecting retail investors from pump and dumps is a very, it's a noble goal, but it's being instituted all wrong. I will say that the sort of investments that a very dedicated sort of traditional value investor is making in microcap and illiquid stuff and dark companies is not the kind of stock that's going to be subject to any kind of pump and dump or manipulation. That tends to be shells and companies that call themselves like blockchain, cannabis, 3D printing, space exploration, things like that. It's very, very obvious what the true garbage companies are, and those are the ones that get pumped by boiler room operations. And it's not the family-owned manufacturer that's been traded OTC for 30 years, or the community bank or things like that. And I think my hope is, and I have a little bit of optimism, not too much, but based on the comments that OTC Markets made, I do hope that the SEC finds a way to differentiate between companies that are legitimate operations and just happen to be dark companies versus stocks that do have high potential for manipulation and fraud. And I hope they find a way to divide those, whether it's based on their share price or some kind of asset test that the company has, or even the formation of an expert market that OTC Markets recommend. That I'd be okay with that as well. That if you could demonstrate some level of financial sophistication, then you're okay to trade these things. It'll be a real tragedy if some of these great companies are just almost totally untradeable in public markets following a rule change. Investors will be hurt to the tune of hundreds of millions of dollars. I think that's terribly unfortunate, but we just, I guess, have to wait and see at this point.
Right. I literally was just going to ask, if you were to be the next chairman of the SEC, how would you handle it? You more or less answered that question.
I mean, I would try my hardest to really dial in on the obvious frauds in stocks that really exist for no other reason. I always joke, if you spend any time looking at stocks traded over the counter, you'll find a large number of them that they say they have a business, but their real business is issuing stock. That's the only thing they ever actually do. And I would say that those are the companies you want to focus on, not the companies that have real cash flow and real businesses.
Gotcha.
Those
All
are
right.
the ones you want to get rid of.
For sure. So then what would you say is the most difficult part of your job now? I mean, I feel like there's so many places we could hit on here, from the, some of the companies maybe that you saw 6 years ago and getting bid up like crazy, to now managing a fund versus being an individual investor. But,
Yeah.
rather than me projecting, I think I should just ask, so you tell me, what is the most difficult part?
I would say that it's really just decide. Well, I mean, every day you take a look at the market, and there is a huge selection of things you can invest in. And you have to say no to almost everything and yes to just a few things. And so the hardest part for me is saying, okay, I have like 50 ideas that I like. Which of those do I invest in? And which of those do I just let pass me by? And it's the whole thing about you don't have to swing at every pitch. And I struggle with that sometimes because I have kind of a hyperactive mind. I'm always looking for new ideas. I feel like I come across new ideas fairly often. And every time I come across an idea, though, I have to really sit down and say, okay, I like this idea, but I have to make sure I'm not just excited about it because it's new and shiny. I have to make sure it's not actually not better than one of my existing ideas. So you have to compare your new ideas versus the things you already own. And the majority of the time, the right decision is to just keep on holding what you already own or buy more of it because you understand that company well, you have experience with it. But I think investors, we're always looking for the new thing. And it's exciting to find a new idea, but you have to be willing to say, okay, that's a good idea, but not now, and put it on your watch list. Or just say, it's a great idea, but this thing I already hold is better. And so it's a difficult thing, picking out which of your ideas is the best and what do you think has the best return potential per unit of risk that you're taking on. And you have to let some really good ideas just go floating by. And that's hard. I'm the kind of investor, I want to do everything, but I can't. And that's hard. And I really have to tell myself, stick to what you're best at.
Well,
Uh,
well, is your portfolio relatively more concentrated, or do you happen to have positions in quite a few stocks?
we are concentrated. We're not super concentrated. I mean, I know people who have 30, 40% of the portfolio in one stock, and that's not, I don't run that way. I do think it's just, well, I think it's a humility thing. I don't believe I can truly know a company so well that I'd be comfortable making it that much of my portfolio. I mean, I could talk to management every day and memorize every financial statement for the past 10 years, and there could still be some employee somewhere in the company performing some fraud I wouldn't know about, and they could get hit by anything could happen. I mean, a volcano could open up under company headquarters tomorrow and everyone could fall in and that would be a disaster. And so I think you have to remember that the world is a really unpredictable place. And you can do as much as possible to be aware of every risk and incorporate that in your valuation, and things can still happen. And so we tend to top out at around 10 to 12% of the portfolio at our largest position that we think has great return potential and very, very little downside. And we scale down from there. But typically, the top 50% of our portfolio is 5 or 6 names, and the scales down from there. And that's a level of concentration and risk I'm comfortable with. So, no, we're probably never going to be the fund that has a year where we do 70 or 80%, maybe coming out of a bear market or something. But we're probably also not going to be the fund that falls 30 or 40 or 50%, just because we like to spread the bets around a little bit. At the same time, I do think there's a lot of wisdom in Buffett saying, why would you invest in your 20th best idea compared to putting more funds into your best? And so we try to strike the balance. We hit meaningful exposure to the ideas we think are great, but we also are willing to put a little bit of capital into other ideas that provide some kind of diversification benefit or just a check on our own hubris.
Nice. So then what investing experience would you say impacted you the most in your career?
Oh, I mean, definitely got to be one of the times that probably the first significant loss I took after launching Alluvial. I was super, super hyped up on this company called Awilco Drilling, and I don't own any of it anymore. And that was years and years ago. But I remember it was this company. They were a Norwegian company that had this really cool special. It was just kind of a special situation. They purchased a couple of offshore drilling rigs at a fire sale price from a forced seller, refurbished them, and now they were leasing them out into a really, really hot market. And they kind of committed they were just going to distribute all their free cash flow. And if you looked just a couple quarters out, they were trading like 2 times what that free cash flow was going to be. And so I was super, super excited about it, and I bought a whole bunch. And at first it was amazing. I bought it at like 13 or 14 in US dollar equivalents, and it went up to 30 or so, and it paid like $3 in dividends along the way. I felt like a god. I mean, honestly, I was so excited. It was just and this is like the first year managing outside money. I was like, this is easy. Like, here, assets are just going to come rolling in, and we're going to be some hot firm in a couple of years. And yeah, that's not at all what happened. I mean, just at the point where I should have been selling, the offshore market for oil was at its peak, and there were more and more rigs coming into the market, and it would have been a great time to at least take some profits, because it's a cyclical industry, but probably should have been selling. And I didn't. And the share price started to slide and slide and slide. And I told myself, things will turn around. This is temporary. They're the cheap. They have great operators. They're the cheapest of all their competitors out there. And well, I ended up selling right at about break even after dividends, and took about 18 months for the whole thing to happen. So essentially it was dead money for 18 months. And it taught me a lesson that I honestly had to relearn a couple times before it really took. But cyclicals are a different creature. Anytime you're investing in a business that doesn't fully control, that's a price taker, where it gets paid little in bad times and it gets paid a lot in good times. Make sure that you're looking past whatever the current market is, and you're looking through the full cycle. Mm-hmm. I shouldn't have been saying this company's making all this money, it's at 5 times earnings. I should have been saying, yeah, they're making a lot of money now, but now they're trading at like 12 or 13 times full cycle earnings, and that's a lot for a cyclical like this, and I should have been selling. But it was very, very good for me to have a disaster of an investment early on. It really, really taught me to be a lot more cautious and a lot more skeptical of my own knowledge and abilities, and I think that's served us well.
Hey, look, at least you didn't lose your shirt on it. I mean, at least that's another silver lining there.
Well, that's happened after that. But that time I didn't. It's true.
So then, what advice would you have for new investors that are looking to invest in the stock market, and not just the stock market in general, but also maybe even looking at, some of these small, illiquid, dark names?
Yeah. Well, first, let me clarify one thing. I've been saying I and we the whole time, and I use it interchangeably. Alluvial is a small firm. I'm the portfolio manager, but I have an assistant named Tom. He's been with me for about a year and a half. He does a great job. So I sometimes flip back and forth and confuse people. Like, wait a minute, is it you or is it we? We'll just say I, but I do have an assistant who does a great job.
Well, look, as long as you don't call it look, you could call yourself the Alluvial Group. You got more than one.
That's true.
That's true. From Entourage, it's like the Murphy Group. It's like, it's only you.
It's technically true, which is, I guess, the best kind of true. So, okay. Advice for, you said like new investors?
Yeah,
is that what you said?
New investors, and even ones that are currently invested in the market right now, if you want to kind of give your 2 cents on what you see, what's going on, especially when it comes to the small, liquid, dark area.
Sure. I would say that you're going to lose money, and you got to be comfortable with it. And when you do, you can't take it personally. Take it personally to the degree that it motivates you to learn and avoid making a mistake if you made one. But losing money isn't always your fault. The market is going to do what it's going to do. But I think the important thing to remember is you wake up in the morning, you check in with your stocks, you do it a few times during the day. There's going to be days when you're down and you can't let it get you down. And there's going to be days when you're up, and weeks and months as well. And yeah, enjoy it, but remember that it's temporary. And what really matters is the progression of quarters and years and decades rather than what happens to you this particular day or week or month. I think as long as you commit yourself to learning more every single day with every investment you make and just building on that knowledge, you'll get where you want to go. I do think, if 10 years from now you're still making the same mistakes that you made today, maybe full-time investing is not your thing, and which is fine. I mean, everyone has their own skills and talents. But just commit to improving and don't get discouraged if it seems to be happening slowly or you're really, really out of sync with the market right then. As long as you learn from it, the effort is not wasted and it's not lost. It's just like, athletes don't win every game. Baseball players don't get hit every at bat. And as long as
unless you're the Astros, in 2017. Sorry, I'm a Yankee fan. So listen, man, I'm a Yankee fan. So anytime I can get an Astros dig in, I will. But anyway, I hear you.
Well, I'm a very, very long-suffering Pirates fan, so I will take any dig at any other better team as well. It makes sense for me. Yeah, and I guess especially as it pertains to microcap, illiquid, dark companies, I think skepticism is the name of the game. You're going to find a lot of companies that really, really look great at first glance. But even in a relatively inefficient market like this market, most companies are trading at the valuation they're trading at for a good reason. If you find a company that's trading, it looks like it's trading at single-digit PE, has a good balance sheet and reasonably good management, it doesn't automatically make it a great investment. There's probably something that's causing the stock to trade at that level. If you do all your homework and you get really, really confident that it truly is just an overlooked opportunity, well, awesome. Maybe you did find one, but you have to do your homework. Don't just assume that the stock looks cheap. It is cheap. Remember that you're not alone in this market. Hundreds of people have looked at this stock and they passed on it for whatever reason. And it's unlikely that you are so special that you found that gem. And maybe you did now and then, but most of the time, the market is reasonably efficient and is reasonably good at incorporating information. And it really takes a lot of work and effort and even experience to get confident that you've truly found something exceptional.
Gotcha. All right. Now, before I let you go real quick, just want to make sure you are not a shareholder in any of the names mentioned. UPS, Frontier, CenturyLink. I think it was a CenturyLink competitor to, I think I heard South Stream, or I couldn't hear it. But
Sure.
and then Comcast, Charter, or Verizon?
Good question. I think I own one share of UPS personally, so probably counts. I own a little bit of Frontier debt, no shares though. Otherwise, no shareholding in Comcast, Verizon, Windstream, or CenturyLink.
Perfect.
Yeah.
All right, Dave, we're at that point. So with that, where can my audience go and find more information about you, OTC Adventures, and Alluvial Capital?
Yeah, absolutely. So I still write on OTCAdventures.com. That's the blog. I keep going. Try to write a couple times a month. If I can, great. If not, well, I'm doing other things. I'm pretty active on Twitter, twitter.com/Alluvial Capital, and just alluvialcapital.com for information about our investment management practices.
Dave, thank you so much for joining me today. This was a lot of fun, and I look forward to the next time we get to speak.
Totally. Thanks for having me on. Great conversation.
Thank you.